going to continue our study of product costing in this video with the focus on overhead cost allocation. There really are two difficult parts of keeping track of product costs. The first one, which we don't talk about extensively in this class, is deciding whether a cost is a product cost or a period cost. And that's a judgment for accountants and production people who are very familiar with the product and also with the accounting rules. The next decision is how to allocate costs. Now, it's not a difficult decision from the point of view of determining cost for generally accepted accounting principles. However, it is a difficult decision if you're trying to get the costs that are assigned to a product to actually reflect the actual cost of that product. In the previous video, we took the overhead account, which had this balance of $10,000, and assigned it to the jobs with the allocation of $4,000 and $6,000. But I didn't explain where that allocation may have come from or how it was done. So in order to assign overhead, we need two things. We need to know, first of all, how much overhead to assign, and then we need what's called a cost driver or a cost basis. If we have that information, then we can calculate an overhead rate by taking the total overhead and dividing by the total amount of the cost driver activity. So in our example, the amount of the overhead was $10,000. What we need is the cost driver or cost basis activity. So let's suppose that there were only 2 jobs worked on during the period, and that job 1 used 200 machine hours and job 2 used 300 machine hours. And we were going to use machine hours as the cost driver. Now we have enough information to calculate an overhead rate. The overhead rate is the total amount of overhead, $10,000, divided by the total cost driver activity, which is 200 machine hours plus 300 machine hours, and that would work out to what? 10,000 divided by 500, or $20 per machine hour. Now, once we know that the overhead rate is $20 per machine hour, we can charge overhead to the individual jobs. So for job 1, it used 200 machine hours times $20, or $4,000. And the way an accountant would record that is with a debit of $4,000 to job 1, right? So remember that the work in process balance is going up, and a credit to manufacturing overhead, that balance is going down of $4,000. Now for job number 2 used 300 machine hours. The overhead rate is still $20 per machine hour, and we get $6,000. We see a debit to the job of $6,000 and a credit to the overhead account for $6,000. And here's the accounting. So we have $10,000 in the overhead account before allocation. We have direct material and direct labor for each of the jobs, direct material, direct labor, and the balances show the cost of the job before the overhead is allocated. Then we take the $4,000 and put it into job number 1, and notice now that the balance for job number 1 has increased by $4,000, and we take $6,000 out of the overhead account with a credit and put a debit into work in process job number 2, and we can see that the balance for job number 2 has increased. Note that other overhead bases or cost drivers could be used. I didn't say much about how we chose this. We don't really talk about it much in this course. We wait for more advanced courses to get into that. However, do note that the choice of overhead base can have a significant impact on the cost of the product. And the reason for that is that these $4,000 and $6,000 are relatively large costs. And if we allocate using a different basis, we could get different numbers there, and those numbers could be quite different from the ones in the current example. This was a case where we used overhead applied using an actual overhead system. An actual overhead system means that we didn't apply the overhead until the end of the period when the actual overhead costs were known and the actual cost driver activity was known. In other words, the total number of overhead costs and the total number of machine hours. Actual accounting systems can only be done at the end of the period because you don't know the totals before that. There are other ways of implementing overhead systems. Some companies use what's termed a predetermined overhead system, and some companies use a standard overhead system. We're not going to get into those too much in this class. These costs are based on estimates of both costs and activities. When you use an estimate, you can assign the overhead in real time. In other words, you don't have to wait until the end of the period. However, anytime you use an estimate, you're going to have estimation errors. Either you're going to assign too much overhead, in which case we say that the overhead was overapplied, or you've assigned too little overhead, in which case we say the overhead was underapplied, and an adjustment would be needed to be made at the end of the accounting period in order to get the overhead balance back to zero.